past performance of companies is important to be able to predict their future performance. And we'll want to know their future performance because we'll want to know if we should buy their stock, should we buy their bonds, should we go work for them, are we going to be able to compete with them in the future? And there's 3 different kinds of analysis that our book talks about: horizontal, vertical, and ratio analysis. So the first thing we learn about is horizontal analysis. Put 2 comparative income statements or 2 comparative balance sheets next to each other and look at the change from year to year. That's why it's called horizontal. So you take the new net sales minus the old net sales divided by the old net sales, and you find out that they had a 14.2% increase, and net income was up by 26.5%. So that's pretty darn good, but we really don't have enough information. We need to know what the rest of the industry was doing and what this company was doing the years before that. So one number all by itself really doesn't give us enough information. We need context. We need to know what the industry is doing and what the company has been doing. Another technique is called vertical analysis. Create common-sized financial statements. So for the income statement, take everything and express it as a percent of that year's sales. Then look across and do a horizontal analysis. So this company last year had net income of 11.4% of sales, and now it's up to 12.6% of sales. Looks like a good improvement, but once again, we need more context. What's happening to the rest of the industry and what's been happening to this company previously. And when you start to look at the industry, how do you compare a $1 million company to a $1 billion company? Well, you use ratios. For example, you might take both companies' current assets and divide it by their current liabilities. That tells you, are they going to be able to pay their bills in the short run? It's not perfect, but it's a quick and easy way to test. The asset test says, well, it takes a long time to sell our inventory. Let's only use our quick assets, the stuff that's going to turn into cash quickly, in the numerator of that fraction. You can look at accounts receivable turnover. If you had a drawer full of invoices, how many times during the year did you send out invoices, and how many times did you empty out that drawer when you got paid? Same thing with inventory turnover. How many times did you fill up your warehouse and empty it out? The more times, the better. Profit margin is simply net income over sales, and that's going to depend on your industry. 2% is good in the grocery business. It's lousy in the computer business. Asset turnover, how effectively are you using your assets to generate your sales? What's your return on assets? Take your net income and divide it by your total assets. Are you using them wisely? Return on common stockholders' equity, take the net income, subtract the preferred dividends, because those belong to the preferred shareholders, and divide that by the average common shareholders' equity. And every book is going to have different formulas, but our book says net income minus preferred dividends over average common stockholders' equity. Earnings per share, net income minus preferred dividends, divided by the weighted average shares outstanding. How much earning power do you buy when you buy a share of stock? PE ratio, how much does the market like you? If your PE ratio is high, it means they expect you to do great things in the future. Payout ratio, how much of your money are you keeping, and how much are you paying out in the form of dividends? Solvency ratios are things like total liabilities over total assets. How much of our right-hand side of the balance sheet is debt? In the U.S., it's probably between 40% and 60%. And times interest earned is a quick and easy way to see if a company has too much debt. The net income minus the interest expense plus income tax expense over interest expense. And again, every book is going to have different formulas. And once again, just having one number, the current ratio for one company for 1 year, isn't enough. We're going to need to know what's happening to the rest of the industry and what's been happening to this company. What are the trends within the company that we're analyzing? And that's a quick introduction to financial analysis.